Hi there, hope you're well. Election day coming up on Saturday, so I hope you get a sausage sandwich and the best person wins. We've had a couple of clients touch base with us this week about what's been going on in markets. So obviously been a little bit up and down, probably a little bit more down than up just of late. So I thought we'd share a few thoughts with you, and I'm going to go over to another screen here to do that. So markets have had a pretty good 10 years in the scheme of things. So over this side, we can see performance of Australian equities, global equities, emerging market equities, so in places like China and India, and also Australian small companies. We can see the trends generally been up. There's obviously been some bumps in the road. That's COVID there. But Australian shares over the last 10 years have generated a return of 11% per annum. Global shares have generated returns of 14% per annum. And the other risk assets that we generally see have performed very well too. So it's been a pretty good 10 years. And that's as we know, that's never going to last forever. We are seeing some clouds on the horizon. Markets obviously are as well. The two main ones that we're seeing is that inflation, the cost of goods is obviously picking up, and monetary policy, so managing interest rates, is perhaps a little bit trickier than it has been in the past. So why are we seeing this high inflation? Probably in our minds, two reasons. We've got the conflict in the Ukraine. Ukraine produces a lot of wheat. We've got Europe trying to not buy oil and gas and other products from Russia, so that is pushing up the costs of goods. And then we've got what we call here the forgotten coronavirus. Obviously, that is creating issues in providing supply of goods. So if you're trying to buy a new car at the moment, it's hard to get one. You could be waiting up to a year. That pushes up the price of goods, and we're seeing that flow through into construction and building. If we have a look at that in some more detail, we can see here the price of gas. This is back to 2017. It's spiked significantly over the last little while. Same for wheat. So that's pushing through into the prices of obviously lots of goods. And I looked to fill my car up today, and I saw petrol prices here we're back up over $2 a litre as well. When we talk about monetary policy, as I mentioned before, we're talking about interest rates, and we've got two charts here. On the left is the cash rate, or the interest rate here in Australia, and the green line is showing what it has been. So it's been at 0.25% for the last little while. That has now crept up to 0.35%. And the blue line here is showing what are we expecting, or what is the market expecting those interest rates to do. And the market is showing that they think interest rates are going to go to probably 3% by the end of this year, and up to over 3.5% by 2023. That would potentially mean that people are paying, if they're on a variable interest rate mortgage, you're potentially paying an interest rate of 5% there. So I don't know if markets have got that right. Perhaps they do, perhaps they don't. There is a lot of debt in Australia now, and we'll have a look at that in a sec. So I think people with variable mortgages are going to be fairly sensitive to those rate rises. In the US, rates have been even lower. They've been at zero and perhaps negative over some of that period. Markets are expecting those rates to pick up to probably close to 3.5% by 2023. So there's going to be higher interest rates in the economy. This is showing the amount of debt that we have here in Australia, household debt, so mums and dads and just general people. And you can see that this is debt compared to people's incomes. And it's been growing significantly. This chart goes all the way back to 1976. So you can see that back in 1976, the amount of debt that people held compared to their income was about sort of 40 times. It is now up at around 180. So that's a big increase, and it means that people are more sensitive to interest rates. So if you kind of think about someone that had a mortgage 10 years ago at $500,000, and maybe people have got $1 million mortgages now. When interest rates go up, that hits the back pocket a bit harder because those repayments are a higher figure, and we haven't seen incomes keep up with that. In the US, it's a different sort of story. In the US, most mortgages are actually fixed for 30 years, but they have a large amount of government debt there. And you can see when you look at the amount of debt the US federal government has compared to gross domestic product, which is all of the goods that get produced in the US, that has increased significantly as well. So in the US, the government's actually going to be quite sensitive to those interest rates. What does all this mean? We're of a view that probably returns from assets are going to be lower than what we've seen over the last 10 years. And we're probably going to see more ups and downs in markets. And we've certainly seen that over the beginning of this year. One question that somebody asked the other day, should we just put everything into cash? Cash, whilst it's a stable asset, and it makes sense to have cash and term deposits, particularly in when you're in pension phase and you're drawing down from your investments, because that can help to reduce the need to sell growth assets to fund pension payments. But the thing to keep in mind is when we've got high inflation. So this chart's talking about in the US. In the US, they're looking at inflation of around 9% at the moment. This chart's sort of showing it's at 8% here. But the cash rate in the US has basically been zero. And so this blue line is showing if you invested in cash in the US, if you've got inflation at 8 or 9%, and you've got a cash rate here at 1%, it's probably a 7% difference there. So when you take into account that the cost of goods has gone up and you've made 1%, you've actually lost money. You've lost purchasing power. Not quite as dramatic here in Australia, but if you said that if inflation in Australia is at 5% at the moment and you can get maybe 2.5% on a term deposit over the course of a year, you've lost 2.5% of your purchasing power. So look, we think there is a place for cash and term deposits in most portfolios, but putting everything in there, you're effectively at this point in time guaranteeing that you're losing purchasing power on that money. How do we manage these events and things that we're seeing? Diversification, so not putting all your eggs in one basket. When we talk about diversification, we mean putting money into different asset classes, so having money in Australian shares, overseas shares, bonds, defensive assets. Also looking at using different companies there and different sectors too. So at the moment, technology the technology sector isn't going so great. Resources is going good. 2 years ago, it was the other way around. So that can change overnight. So having a good spread definitely helps. Making sure we're using cost-effective investments. So we use a lot of index investments with clients. That helps to reduce the cost of the portfolio. And if you take a view that returns are maybe going to be lower, having a lower cost definitely helps there as well. Also making sure that you're investing for the right time frames. So if you're thinking that you're going to need money in 12 months' time, perhaps it doesn't make sense to be putting that money into the share market at the moment because we don't know where markets are going to be in 12 months' time. If you're thinking you've got surplus money and you're not going to need it for 10 years, then you've maybe got the time to ride out the cycle if markets go up and down. I would encourage you, if you're thinking about doing that, go and seek some advice and make sure that you're taking all of your personal circumstances into account. Last of all, if you've got any questions, that's what we're here for. If you're feeling stressed or you're not too sure, just give us a call. We're always happy to help. But until next time, stay well and we'll talk to you soon. Cheers.